Welcome back to our channel. Let us keep talking about money, and if you are new here, please subscribe to our channel. Let's talk about credit cards. A credit card is a payment card issued to users, cardholders, to enable the cardholder to pay a merchant for goods and services based on the cardholder's accrued debt, i.e., promise to the card issuer to pay them for the amounts plus the other agreed charges. The card issuer, usually a bank or credit union, creates a revolving account and grants a line of credit to the cardholder, from which the cardholder can borrow money for payment to a merchant or as a cash advance. There are two credit card groups: consumer credit cards and business credit cards. Most cards are plastic, but some are metal cards: stainless steel, gold, palladium, titanium, and a few gemstone-encrusted metal cards. A regular credit card is different from a charge card, which requires the balance to be repaid in full each month or at the end of each statement cycle. In contrast, credit cards allow the consumers to build a continuing balance of debt, subject to interest being charged. A credit card differs from a charge card also in that a credit card typically involves a third-party entity that pays the seller and is reimbursed by the buyer, whereas a charge card simply defers payment by the buyer until a later date. A credit card also differs from a debit card, which can be used like currency by the owner of the card. Alternatives to credit cards include debit cards, mobile payments, digital wallets, cryptocurrencies, pay by hand, bank transfers, and buy now, pay later. As of June 2018, there were 7.753 billion credit cards in the world. In 2020, there were 1.09 billion credit cards in circulation in the U.S. and 72.5% of adults, 187.3 million, in the country had at least one credit card. A credit card is a thin rectangular piece of plastic or metal issued by a bank or financial services company that allows cardholders to borrow funds with which to pay for goods and services with merchants that accept cards for payment. Credit cards impose the condition that cardholders pay back the borrowed money, plus any applicable interest, as well as any additional agreed-upon charges, either in full by the billing date or over time. A cash advance is a credit card transaction that withdraws cash rather than purchasing something. The process can take place either through an ATM or over the counter at a bank or other financial agency, up to a certain limit. For a credit card, this will be the credit limit, or some percentage of it. Cash advances often incur a fee of 3 to 5% of the amount being borrowed. When made on a credit card, the interest is often higher than other credit card transactions. The interest compounds daily starting from the day cash is borrowed. Some purchases made with a credit card of items that are viewed as cash are also considered to be cash advances in accordance with the credit card network's guidelines, thereby incurring the higher interest rate and the lack of the grace period. These often include money orders, prepaid debit cards, lottery tickets, gaming chips, mobile payments, and certain taxes and fees paid to certain governments. However, should the merchant not disclose the actual nature of the transactions, these will be processed as regular credit card transactions. Many merchants have passed on the credit card processing fees to the credit card holders in spite of the credit card network's guidelines, which state the credit card holders should not have any extra fee for doing a transaction with a credit card. Under card scheme rules, a credit card holder presenting an accepted form of identification must be issued a cash advance over the counter at any bank which issues that type of credit card, even if the card holder cannot give their PIN. A Japanese law enabling credit card cashback came into force in 2010. However, a legal loophole in this system was quickly exploited by online shops dedicated to providing cashback as a form of easy loan with exorbitant rates. At first, the online store sells a single inexpensive item of glass marble, golf tee, or eraser with an 80,000 yen wire transfer for a 100,000 yen, $1,200 credit card payment. A month later, when the credit card provider charges the card owner with the full fee, the online store is out of the picture with no liability. In effect, what the online cashback services provide are loans with a 300% annual interest rate. On October 19, 2010, Hideki Fukubo became the first operator of such an online cashback service to be charged by the police. He was charged on tax evasion of 40 million yen in unpaid taxes. A credit card issuing company, such as a bank or credit union, enters into agreements with merchants for them to accept their credit cards. Merchants often advertise in signage or other company material which cards they accept by displaying acceptance marks generally derived from logos. Alternatively, this may be communicated, for example, via a restaurant's menu or orally, or stating, "We don't take credit cards." The credit card issuer issues a credit card to a customer at the time or after an account has been approved by the credit provider, which need not be the same entity as the card issuer. The card holders can then use it to make purchases at merchants accepting that card. When a purchase is made, the card holder agrees to pay the card issuer. The card holder indicates consent to pay by signing a receipt with a record of the card details and indicating the amount to be paid or by entering a personal identification number, PIN. Also, many merchants now accept verbal authorizations via telephone and electronic authorization using the Internet, known as a card not present transaction, CNP. Electronic verification systems allow merchants to verify in a few seconds that the card is valid and the card holder has sufficient credit to cover the purchase, allowing the verification to happen at time of purchase. The verification is performed using a credit card payment terminal or point of sale, POS, system with a communications link to the merchant's acquiring bank. Data from the card is obtained from a magnetic stripe or chip on the card. The latter system is called chip and PIN in the United Kingdom and Ireland, and is implemented as an EMV card. For card not present transactions where the card is not shown, e.g., e-commerce, mail order, and telephone sales, merchants additionally verify that the customer is in physical possession of the card and is the authorized user by asking for additional information such as the security code printed on the back of the card, date of expiry, and billing address. Each month, the card holder is sent a statement indicating the purchases made with the card, any outstanding fees, the total amount owed and the minimum payment due. In the US, after receiving the statement, the card holder may dispute any charges that he or she thinks are incorrect. The Fair Credit Billing Act gives details of the US regulations. Many banks now also offer the option of electronic statements, either in lieu of or in addition to physical statements, which can be viewed at any time by the cardholder via the issuer's online banking website. Notification of the availability of a new statement is generally sent to the cardholder's email address. If the card issuer has chosen to allow it, the cardholder may have other options for payment besides a physical check, such as an electronic transfer of funds from a checking account. Depending on the issuer, the cardholder may also be able to make multiple payments during a single statement period, possibly enabling him or her to utilize the credit limit on the card several times. Minimum payment. The cardholder must pay a defined minimum portion of the amount owed by a due date or may choose to pay a higher amount. The credit issuer charges interest on the unpaid balance if the billed amount is not paid in full, typically at a much higher rate than most other forms of debt. In addition, if the cardholder fails to make at least the minimum payment by the due date, the issuer may impose a late fee or other penalties. To help mitigate this, some financial institutions can arrange for automatic payments to be deducted from the cardholder's bank account, thus avoiding such penalties altogether, as long as the cardholder has sufficient funds. In cases where the minimum payment is less than the finance charges and fees assessed during the billing cycle, the outstanding balance will increase in what is called negative amortization. This practice tends to increase credit risk and mask the lender's portfolio quality and consequently has been banned in the US since 2003. Advertising, solicitation, application, and approval. Credit card advertising regulations in the US include the Schumer box disclosure requirements. A large fraction of junk mail consists of the credit card offers created from lists provided by the major credit reporting agencies. In the United States, the three major U.S. credit bureaus, Equifax, TransUnion, and Experian, allow consumers to opt out from related credit card solicitation offers via its opt-out pre-screen program. Interest charges. Credit card issuers usually waive interest charges if the balance is paid in full each month, but typically will charge full interest on the entire outstanding balance from the date of each purchase if the total balance is not paid. For example, if a user had a $1,000 transaction and repaid it in full within this grace period, there would be no interest charged. If, however, even $1 of the total amount remained unpaid, interest would be charged on the $1,000 from the date of purchase until the payment is received. The precise manner in which interest is charged is usually detailed in a cardholder agreement, which may be summarized on the back of the monthly statement. The general calculation formula most financial institutions use to determine the amount of interest to be charged is APR/100x ADB/365x number of days revolved. Take the annual percentage rate, APR, and divide by 100, then multiply to the amount of the average daily balance, ADB. Divide the result by 365 and then take this total and multiply by the total number of days the amount revolved before payment was made on the account. Financial institutions refer to interest charged back to the original time of the transaction and up to the time a payment was made, if not in full, as a residual retail finance charge, RRFC. Thus, after an amount has revolved and a payment has been made, the user of the card will still receive interest charges on their statement after paying the next statement in full. In fact, the statement may only have a charge for interest that collected up until the date the full balance was paid, i.e. when the balance stopped revolving. The credit card may simply serve as a form of revolving credit, or it may become a complicated financial instrument with multiple balance segments, each at a different interest rate, possibly with a single umbrella credit limit, or with separate credit limits applicable to the various balance segments. Usually, this compartmentalization is the result of special incentive offers from the issuing bank, to encourage balance transfers from cards of other issuers. If several interest rates apply to various balance segments, then payment allocation is generally at the discretion of the issuing bank, and payments will therefore usually be allocated towards the lowest rate balances until paid in full before any money is paid towards higher rate balances. Interest rates can vary considerably from card to card, and the interest rate on a particular card may jump dramatically if the card user is late with a payment on that card or any other credit instrument, or even if the issuing bank decides to raise its revenue. Grace period. A credit card's grace period is the time the cardholder has to pay the balance before interest is assessed on the outstanding balance. Grace periods may vary but usually range from 20 to 55 days depending on the type of credit card and the issuing bank. Some policies allow for reinstatement after certain conditions are met. Usually, if a cardholder is late paying the balance, finance charges will be calculated and the grace period does not apply. Finance charges incurred depend on the grace period and balance. With most credit cards there is no grace period if there is any outstanding balance from the previous billing cycle or statement, i.e. interest is applied on both the previous balance and new transactions. However, there are some credit cards that will only apply finance charges on the previous or old balance, excluding new transactions. Parties involved. Cardholder, the holder of the card used to make a purchase, the consumer. Card issuing bank, the financial institution or other organization that issued the credit card to the cardholder. This bank bills the consumer for repayment and bears the risk that the card is used fraudulently. American Express and Discover were previously the only card issuing banks for their respective brands, but as of 2007, this is no longer the case. Cards issued by banks to cardholders in a different country are known as offshore credit cards. Merchant, the individual or business accepting credit card payments for products or services sold to the cardholder. Acquiring bank, the financial institution accepting payment for the products or services on behalf of the merchant. Independent sales organization, resellers, to merchants, of the services of the acquiring bank. Merchant account, this could refer to the acquiring bank or the independent sales organization, but in general is the organization that the merchant deals with. Card Association, an association of card-issuing banks such as Discover, Visa, MasterCard, American Express, etc. that set transaction terms for merchants, card-issuing banks, and acquiring banks. Transaction network, the system that implements the mechanics of electronic transactions. May be operated by an independent company, and one company may operate multiple networks. Affinity partner, some institutions lend their names to an issuer to attract customers that have a strong relationship with that institution, and get paid a fee or a percentage of the balance for each card issued using their name. Examples of typical affinity partners are sports teams, universities, charities, professional organizations, and major retailers. Insurance providers, insurers underwriting various insurance protections offered as credit card perks, for example, car rental insurance, purchase security, hotel burglary insurance, travel medical protection, etc. The flow of information and money between these parties always through the card associations is known as the interchange, and it consists of a few steps. Transaction steps. Authorization, the card holder presents the card as payment to the merchant and the merchant submits the transaction to the acquirer, acquiring bank. The acquirer verifies the credit card number, the transaction type and the amount with the issuer, card issuing bank, and reserves that amount of the cardholder's credit limit for the merchant. An authorization will generate an approval code, which the merchant stores with the transaction. Batching, authorized transactions are stored in batches, which are sent to the acquirer. Batches are typically submitted once per day at the end of the business day. Batching can be done manually, initiated by a merchant's action, or automatically, on a predetermined schedule, using a payment processing platform. If a transaction is not submitted in the batch, the authorization will stay valid for a period determined by the issuer, after which the held amount will be returned to the cardholder's available credit. Some transactions may be submitted in the batch without prior authorizations. These are either transactions falling under the merchant's floor limit or ones where the authorization was unsuccessful but the merchant still attempts to force the transaction through. Such may be the case when the cardholder is not present but owes the merchant additional money, such as extending a hotel stay or car rental. Clearing and settlement, the acquirer sends the batch transactions through the credit card association, which debits the issuers for payment and credits the acquirer. Essentially, the issuer pays the acquirer for the transaction. Funding, once the acquirer has been paid, the acquirer pays the merchant. The merchant receives the amount totaling the funds in the batch minus either the discount rate, mid-qualified rate, or non-qualified rate, which are tiers of fees the merchant pays the acquirer for processing the transactions. Chargebacks. A chargeback is an event in which money in a merchant account is held due to a dispute relating to the transaction. Chargebacks are typically initiated by the cardholder. In the event of a chargeback, the issuer returns the transaction to the acquirer for resolution. The acquirer then forwards the chargeback to the merchant, who must either accept the chargeback or contest it. Credit card register. A credit card register is a transaction register used to ensure the increasing balance owed from using a credit card is enough below the credit limit to deal with authorization holds and payments not yet received by the bank and to easily look up past transactions for reconciliation and budgeting. The register is a personal record of banking transactions used for credit card purchases as they affect funds in the bank account or the available credit. In addition to checking numbers and so forth, the code column indicates the credit card. The balance column shows available funds after purchases. When the credit card payment is made, the balance already reflects the funds were spent. In a credit card's entry, the deposit column shows the available credit and the payment column shows the total owed, their sum being equal to the credit limit. Each check is written, debit card transaction, cash withdrawal, and credit card charge are entered manually into the paper register daily or several times per week. Credit card register also refers to one transaction record for each credit card. In this case, the booklets readily enable the location of a card's current available credit when 10 or more cards are in use. In addition to the standard credit line, the credit card issuer may also grant a separate cash line of credit, LOC, to cardholders, enabling them to borrow money in the form of cash advances that can be accessed through bank tellers, ATMs, or credit card convenience checks. Such cash advances typically have different terms, such as no grace period and higher interest rates, compared with those transactions that access the main credit line. Issuers customarily preset borrowing limits based on an individual's credit rating. A vast majority of businesses let the customer make purchases with credit cards, which remain one of today's most popular payment methodologies for buying consumer goods and services. Business credit cards are specialized credit cards issued in the name of a registered business, and typically they can only be used for business purposes. Their use has grown in recent decades. In 1998, for instance, 37% of small businesses reported using a business credit card. By 2009, this number had grown to 64%. A secured credit card is a type of credit card secured by a deposit account owned by the cardholder. They are sometimes called prepaid credit card, but they are debit cards, prepaid card or prepaid debit card. Since no credit is offered by the card issuer, the cardholder spends money which has been stored via a prior deposit by the cardholder or someone else, such as a parent or employer. However, it carries a credit card brand, such as Discover, Visa, MasterCard, American Express, or JCB, and can be used in similar ways just as though it were a credit card. Unlike debit cards, prepaid credit cards generally do not require a PIN. An exception are prepaid credit cards with an EMV chip. These cards do require a PIN if the payment is processed via chip and PIN technology. As of 2018, most debit cards in the US were prepaid cards, 71.7%. A digital card is a digital cloud-hosted virtual representation of any kind of identification card or payment card, such as a credit card. The main benefit to the cardholder is convenience. Compared to debit cards and checks, a credit card allows small short-term loans to be quickly made to a cardholder who need not calculate a balance remaining before every transaction, provided the total charges do not exceed the maximum credit line for the card. One financial benefit is that no interest is charged when the balance is paid in full within the grace period. Different countries offer different levels of protection. In the UK, for example, the bank is jointly liable with the merchant for purchases of defective products over £100. Many credit cards offer benefits to cardholders. Some benefits apply to products purchased with the card, like extended product warranties, reimbursement for decreases in price immediately after purchase, price protection, and reimbursement for theft or damage on recently purchased products, purchase protection. Other benefits include various types of travel insurance, such as rental car insurance, travel accident insurance, baggage delay insurance, and trip delay or cancellation insurance. Credit cards may also offer a loyalty program, where each purchase is rewarded based on the price of the purchase. Typically, rewards are either in the form of cashback or points. Points are often redeemable for gift cards, products, or travel expenses like airline tickets. Some credit cards allow the transfer of accrued points to hotel and airline loyalty programs. Research has examined whether competition among card networks may potentially make payment rewards too generous, causing higher prices among merchants, thus actually impacting social welfare and its distribution, a situation potentially warranting public policy interventions. Some countries, such as the United States, the United Kingdom, and France, limit the amount for which a consumer can be held liable in the event of fraudulent transactions with a lost or stolen credit card. Detriments to cardholders: high interest and bankruptcy. Low introductory credit card rates are limited to a fixed term, usually between 6 and 12 months, after which a higher rate is charged. As all credit cards charge fees and interest, some customers become so indebted to their credit card provider that they are driven to bankruptcy. Some credit cards often levy a rate of 20 to 30% after a payment is missed. In other cases, a fixed charge is levied without change to the interest rate. In some cases universal default may apply. The high default rate is applied to a card in good standing by missing a payment on an unrelated account from the same provider. This can lead to a snowball effect in which the consumer is drowned by unexpectedly high interest rates. Further, most cardholder agreements enable the issuer to arbitrarily raise the interest rate for any reason they see fit. First Premier Bank at one point offered a credit card with a 79.9% interest rate, however, they discontinued this card in February 2011 because of persistent defaults. Research shows that a substantial fraction of consumers, about 40%, choose a suboptimal credit card agreement, with some incurring hundreds of dollars of avoidable interest costs. Weaken self-regulation. Several studies have shown that consumers are likely to spend more money when they pay by credit card. Researchers suggest that when people pay using credit cards, they do not experience the abstract pain of payment. Furthermore, researchers have found that using credit cards can increase consumption of unhealthy food, compared to using cash. Merchants that accept credit cards must pay interchange fees and discount fees on all credit card transactions. For merchants, card-based purchase amounts reduce resistance compared to paying cash, and the transaction is often more secure than other forms of payment, such as checks, because the issuing bank commits to pay the merchant the moment the transaction is authorized, regardless of whether the consumer defaults on the credit card payment, except for legitimate disputes, and can result in charges back to the merchant. Cards are even more secure than cash because they reduce theft opportunities by reducing the amount of cash on the premises. Finally, credit cards reduce the back-office expense of processing checks/cash and transporting them to the bank. For merchants, card-based purchase amounts reduce resistance compared to paying cash, and the transaction is often more secure than other forms of payment, such as checks, because the issuing bank commits to pay the merchant the moment the transaction is authorized, regardless of whether the consumer defaults on the credit card payment, except for legitimate disputes, and can result in charges back to the merchant. Cards are even more secure than cash because they reduce theft opportunities by reducing the amount of cash on the premises. Finally, credit cards reduce the back-office expense of processing checks/cash and transporting them to the bank. Credit card security relies on the physical security of the plastic card as well as the privacy of the credit card number. Therefore, whenever a person other than the card owner has access to the card or its number, security is potentially compromised. The goal of the credit card companies is not to eliminate fraud, but to reduce it to manageable levels. This implies that fraud prevention measures will be used only if their cost is lower than the potential gains from fraud reduction, whereas high-cost low-return measures will not be used, as would be expected from organizations whose goal is profit maximization. The major credit card fees are 4. Membership fees, annual or monthly, sometimes a percentage of the credit limit. Cash advances and convenience checks, often 3% of the amount. Charges that result in exceeding the credit limit on the card, whether deliberately or by mistake, called over-limit fees. Exchange rate loading fees, sometimes these might not be reported on the customer's statement, even when applied. The variation of exchange rates applied by different credit cards can be very substantial, as much as 10% according to a Lonely Planet report in 2009. Late or overdue payments. Returned check fees or payment processing fees, e.g. phone payment fee. Transactions in a foreign currency, as much as 3% of the amount. A few financial institutions do not charge a fee for this. Finance charges any charge that is included in the cost of borrowing money. When accepting payment by credit card, merchants typically pay a percentage of the transaction amount in commission to their bank or merchant services provider. Merchants are often not allowed to charge a higher price when a credit card is used as opposed to other methods of payment, so there is no penalty for a cardholder to use their credit card. The credit card issuer is sharing some of this commission with the cardholder to incentivize them to use the credit card when making a payment. Rewards-based credit card products like cashback are more beneficial to consumers who pay their credit card statement off every month. Rewards-based products generally have higher annual percentage rates. If the balance is not paid in full every month, the extra interest will eclipse any rewards earned. Most consumers do not know that their rewards-based credit cards charge higher interchange fees to the vendors who accept them. Thank you for watching our videos. You can comment to share our videos and subscribe to our channel.